Hello and welcome to The Explainer. Today, we're diving into a really big update for anyone who invests in gold, especially if you're holding sovereign gold bonds. There's a tax rule change coming that could seriously impact your returns. So, let me ask you something. When you think about sovereign gold bonds, or SGBs, what's the first thing that comes to mind? For a lot of us, it's that amazing feature, tax-free profits, right? Well, if you think that's still the whole picture, hold on, because there's a big change coming up that might just catch you by surprise. Okay, let's get right into it. There's a new rule kicking in come 2026, and it's going to completely change the game for how capital gains on SGBs are taxed. So let's break down exactly what this means for you and your portfolio. All right, first things first, what is this new rule? Well, starting April 1st, 2026, the way SGBs are taxed is changing. And here's a really important point. This isn't just for new bonds issued after that date. Nope, this applies to all active SGBs, so everyone needs to pay attention. So here's the deal. For your SGB profits to be completely 100% tax-free, you now have to check two boxes, not one, but two. First, you have to have bought them directly from the government when they were first issued. And second, you have to hold on to them for the entire 8-year maturity period. Both have to be true. Okay, so what does this actually mean in practice? Who's going to be affected by this? Let's figure out who exactly is now on the hook to pay tax on their SGB profits under these new rules. Basically, it comes down to two main groups of people. The first group, anyone who bought their SGBs on the secondary market, from other investors on the stock exchange. If that's you, any gains you make are now taxable. And the second group? Well, even if you bought your bonds in the original issue, if you decide to sell them before that full 8-year term is up, your profits will be taxed too. And here's the magic number you need to remember. 12.5%. That's right, 12.5%. For those investors we just talked about, the profits are going to be taxed as long-term capital gains, or LTG. Now, what's really interesting is how this tax is calculated. For a lot of other investments, you get something called an indexation benefit, which kind of adjusts for inflation and lowers your tax. But not here. This 12.5% is a flat tax on your gain, which means it could be a bit steeper than you might think at first glance. But wait, it's not all doom and gloom. Even with this new tax in the picture, there's a really clever strategy you can use to manage it. It's called tax loss harvesting, and it's a real game changer. So what on earth is tax loss harvesting? Well, think of it like this. You've got gains in one bucket and losses in another. You intentionally sell an investment that's in the red to realize that loss. Then you take that loss and use it to cancel out a gain you've made somewhere else, say from your SGBs. The bottom line, your total taxable income goes down and you pay less tax. Simple as that. Okay, I know that can sound a little abstract, so let's make it real. We're going to walk through an actual example with some numbers. Trust me, when you see it in action, you'll get just how powerful this strategy can be. All right, let's pretend this is your portfolio for the year. So you've got a taxable gain of 60,000 rupees from your SGBs. Nice. You've also got a solid gain of 1,75,000 from a mutual fund. But you're also holding on to some shares that are down by 70,000 rupees.
Okay, now let's see the two scenarios play out. On one hand, if you do nothing, no tax loss harvesting, your total tax bill comes out to 13,750 rupees. Now, on the other hand, if you use tax loss harvesting, you sell those losing shares, use that loss to cancel out some of your gains, and boom, your new tax bill plummets to just 5,000 rupees. That's a huge difference.
And just look at that comparison. We're talking about a tax saving of 8,750 rupees. Now, to be clear, this doesn't magically erase the fact that your shares lost money. But what it does do is let you strategically use that loss to seriously cut down your tax bill. It's about turning a negative into a positive for your tax planning.
So, after all that, what's the bottom line? What should you actually do with this information? Let's boil it all down to the key takeaways and create a simple action plan for you.
Okay, here's your 3-step action plan. It's super straightforward. Step 1, pull up your portfolio and review all your SGB holdings. Step 2, for each one, figure out how you bought it. Was it from the original government issue, or did you buy it on the secondary market? This is crucial. And finally, step 3, take a hard look at your whole portfolio and see if tax loss harvesting could work for you, especially as you get closer to the end of the financial year. At the end of the day, it's all about being proactive instead of reactive.
When you understand the rules of the game and the strategies you can use, you can make smart, informed decisions that help maximize your returns. It's way better than getting a nasty surprise come tax time, right? So that really is the big question we'll leave you with. Is your portfolio ready for 2026? The rules of the game are definitely changing. But the good news is, with some smart planning, you can totally adapt your strategy and stay ahead of the curve. Thanks so much for joining us on The Explainer.